Welcome to the Utility Calculation Utility Expense Level webinar. Before we get started, please take a moment to review the directions on the screen. During the presentation, if you have any technical issues, please use the chat panel. If you have content-related questions, please use the Q&A panel. Be sure to direct your questions to all panelists. Please note that we may not be able to address all content-related questions today, but we will gather and address each question in a Q&A document. The Q&A document, as well as the recorded webinar, will be available on HUD Exchange in a few weeks. Please also note that the PowerPoint presentation will also be posted to HUD Exchange. You will be able to locate the recording, slides, and any mentioned resources on the class page where you launched this webinar. Our presenter today is Brian Alton from BDO, who partnered with CVR in creating this material. And with that, I'll turn it over to you, Brian.
Thank you very much, and welcome everybody. Good afternoon or good morning, depending where you're located at. And we have a pretty high-level overview session. It's a basic session about the utility expense level calculation. As Caroline mentioned, we have a Q&A session as well. We're going to hold off to answering those questions until the end of the session. So please go ahead and type away those questions and we will address them at the end of the session. We'll go over some basic introductions about myself. I'm Brian Alton. I'm a partner at BDO. I've been providing accounting and consulting to housing authorities for close to 30 years now. And we just focus on the accounting, the consulting, and training for those housing authorities and the related affordable housing entities. We're going to kick off the session by discussing a little background of operating subsidy, how we got there. We're going to focus today on the utility expense level, the UEL, and how that is calculated and why it's important that we have accurate data that we can support when we apply for operating subsidy. We'll review some utility incentives and then wrap it up with some miscellaneous items with a focus on data distortions, which is very important that we want to try to mitigate as much as possible. When we talk about data distortions, I think it's important to know that HUD is really scrutinizing the data that's being provided by the housing authorities to calculate utility subsidy. It comes down to cost and consumption. So we have to make sure we're tracking that accurately. And we have some tips throughout this session that will help you do that. The operating fund calculation is how we get subsidy. The revised 24 CFR 990 was published in September of 2005. And it really gave guidance on two objectives: the transition to asset management and a new subsidy calculation. When housing authorities transitioned to asset management, it was a whole brand new business model for them. It allowed the housing authorities to take their entity-wide public housing portfolio and break it down into an asset management project-based portfolio, which means instead of doing one financial statement, one budget, one subsidy calculation for the entire public housing portfolio, they're now doing a budget for each AMP, a financial statement for each AMP, and a subsidy calculation for each AMP that the housing authority has. And when the housing authority is converted to asset management, probably starting in fiscal year 2007, even though the guidance came out in 2005. There was some overarching factors that determined how to take certain developments and combine them into an AMP. They looked at geographic location, they looked at how large the AMP would be, as well as the type of tenancy, whether it's elderly or family. In addition, the type of units. Was it high-rise, garden-style walk-up, scattered sites, and so forth? Let's skip to the next slide really quick. We'll come back to this slide. So why do housing authorities get subsidized? In the late 60s, the Brooke Amendment came out. And the Brooke Amendment basically said this: we're going to limit a family's rent to 25% of their adjusted income. It's now 30%. Well, the expenses to run that AMP versus the reduced rent is more. So they need subsidy to fill that gap. And that's an oversimplified reason on why the housing authorities are receiving subsidy. So the subsidy kicked in the early 70s, mid 70s, and it went through some changes since that time. The UEL calculation is a piece of the subsidy calculation. We have some slides coming up that will show that. And what's important to know, for the UEL calculation, the utility expense level calculation, we have to obtain the consumption for each type of utility and the cost for each type of utility. We have to know if there's any utility incentives, maybe a frozen rolling base if approved by HUD, or a rate reduction incentive if approved by HUD, a listing of new units and the date they came on during the reporting period, a listing of units either demolished or demoed or repositioned out of the AMP during the reporting period, and any changes in the unit of measurement for consumption. For example, did the unit of consumption from the utility company for like maybe water and sewer go from gallons to metric gallons? And we're going to have to make sure we're consistent in that unit of measurement. If not, it will skew the subsidy calculation. Throughout your fiscal year, housing authorities should be tracking utility cost and consumption monthly by AMP, development within the AMP, and meter. If you can track by address, that would be helpful too. In addition to tracking the units or tracking the data of cost and consumption, we have to be checking and tracking the units coming online and offline, units being removed, of course, because this will affect your overall consumption and your cost as well as your subsidy. I always make it a point when you're tracking the cost and consumption, it'd be great if you can note any anomalies in the recording of the cost and consumption. Maybe there was a cracked water pipe, and that's why you notice for the 1 meter, the water went up. So tracking that, it's helpful. And I guess, when do you track this, right? That's a good question. The question we should be thinking about is, well, how are we going to track this? What I typically see at housing authorities across the country, whether they're large or small, they're tracking as they pay the bills. They're tracking the cost and consumption as they pay the bills. And they receive that invoice and they log it maybe in the software the authority is using or an Excel spreadsheet. But we're going to need this data. It's important that we maintain this data because at some point, HUD could ask for this data so it can be verified. The funding period for operating subsidy is always a calendar year, regardless of your PHA's fiscal year end. If you're March, June, or September year end, it doesn't matter. We receive subsidy and it's measured from January to December. The reporting period is always going to be July to June, 6 months before the calendar year begins. For an example, the reporting period of July 22 to June of 23 is for funding period 2024. The reporting period is going to capture the data to be used for the calculation of subsidy in which the housing authority will receive in the funding period. The type of data that's captured for operating subsidy includes eligible unit months. These are occupied units, HUD approved vacancies, and limited vacancies that are eligible for subsidy. Your normal vacant unit months, and the EUMs, the eligible unit months and vacant unit months, all that comes from PIC, the Public and Indian Housing Information Center. So that is pre-populated data for the subsidy calculation. But the utility consumption and cost will be entered by the PHA. And this is always a significant amount of information, and that's why I mentioned in the previous slide that we should be tracking this monthly. In addition, tracking any anomalies monthly as well, because it's hard to remember when a unit maybe had a broken pipe or there was significant renovations going on and they were offline for a couple of months, whatever it may be. It's always good to have that to explain these variances if HUD requests that data. This is just an example of the reporting period versus the funding period. So in this example, we have the reporting period of July 1st, 2022 through June 30th, 2023. That's the data collection that's happening at the PHA. HUD is using that data to fund the PHA in calendar year 2024. HUD aims to submit the operating subsidy calculation before January 1st of the upcoming year. So I think last year it happened in October, November. It got submitted. And HUD's going to try to keep to this format. We're submitting our subsidy now in the OptSub portal, which is pretty clean. It's pretty easy to use. It's quite intuitive as well. This is a high-level overview of what the subsidy calculation looks like. The subsidy calculation is on HUD Form 52723. It consists of a project expense level, a PEL, the utility expense level, which we're going to focus this session on, which comes from another form, HUD Form 52722, add-ons, transition funding, dwelling rental income, and that is your subsidy calculation. That's your eligibility of subsidy. And this is a high-level overview of, again, HUD Form 52723. So the project expense level consists of about 10 coefficients and the related variables. And we can think of the PEL as what it costs to operate a well-run AMP. This calculation was created by the Harvard Graduate School of Design, and the information is in 24 CFR 990, the calculation of that PEL calculation is in there. And this is funding the PHA for those expenses. In addition, once we calculate the UEL, the utility expense level from HUD Form 52722, HUD will fund the the PHA on the PHA paid utility costs. When the PEL was created, there were certain items not included, certain expenses not included in the PEL, such as self-sufficiency, audit, pilot, asset fee, asset management fee, IT fees, asset repositioning fees, resident participation, ad fees as well, just to name a few of them. And those are added to the PEL. And when we take a look at just the PEL, the UEL, and the add-ons, that's known as your formula expense level. So HUD is really saying, this is what it should cost you to operate that AMP. We're going to skip over transition funding momentarily. But according to 2 CFR 200, that program income being generated must be reduced. So if you think about it, HUD's saying, we're going to fund you for the expenses to run your AMP, but we're going to reduce it by your dwelling rental income. And that comes from your latest financial data schedule that was submitted. So they're going to reduce your funding by your rental income, and that will be your subsidy eligibility. The transition funding are for those PHAs that transitioned to asset management early that was losing funding under the new rule. So if we go back to slide 6 here, when this revised 24 CFR 990 rule came out, it required them to transition to this asset management model. And that changed how the housing authority operated. In addition, we got this new subsidy calculation. So if the PHA was losing subsidy under this new calculation, they had an opportunity to transition to asset management early and reduce the loss of their subsidy. So if they transition to asset management early, let's say in the first year, instead of losing 100% of the difference, you added 95% as transition funding back into your expenses, and they would fund you for that. And then after 5 years, you got the housing authority received less and less funding for that. When we focus on the 52722, the calculation of the UEL, again, is the utility expense level. There's a lot of acronyms within HUD, and UEL is the utility expense level. And it is just a piece of the overall subsidy calculation that we're focusing on. We're going to be tracking utility cost and consumption by type of utility so we can get that subsidy for the authority paid utilities. The UEL for each AMP subsidy calculation is based on a formula for each type of utility type and the related rate for that utility. There's an inflation factor that's going to be applied to account for the difference in the reporting period activity versus the funding period. Since we're capturing this data almost 18 months prior to the funding, it has to be inflated to some degree to true up the amount of funds we should be receiving. The UEL is expressed in a per unit month figure, which means this. This is how much subsidy for utilities you're going to get per unit per month. So an example would be $185.76, that each unit's going to receive $185.76 each month for subsidy for UEL. If you have a central office cost center, it's known as a COCC, and it's part of the AMP. Since the COCC is not part of public housing, it is separate. Even though it's located in the AMP, we have to back out any cost of the utility and consumption related to that utility out of our calculation, and it can't be included. A lot of times we see many PHAs use square footage as an example on the percentage of cost and consumption to back out. In addition, and sometimes I see in sewer bills, the cost of garbage and trash, that should be excluded from the cost of utility. That is not a utility cost, garbage and trash. That is considered a maintenance cost, and it should be backed out of the calculation as well. The calculation itself for the UEL is not based on this is what we paid, this is what we're going to give you. It's more of a formula. It's taking the lesser of the reporting period or the 3-year rolling base consumption. And we'll go into that in some detail on what that means. I'm throwing a lot of acronyms at you. I'm throwing a lot of new terms at you as well. And we're going to define what the reporting period is versus the 3-year rolling base consumption when it comes to this UEL calculation. The reporting period consumption is going to be that six months before the funding period. It's going to be July 1 to June 30. For an example, July 1, 2022 to June 30, 2023 for the funding period of 2024. That's the reporting period. So we'll gather that consumption for each type of utility. We're going to compare it to the 3-year average rolling base consumption. Then there will be a utility incentive. There will be a rate that we're going to use for each type of utility. There'll be an inflation factor, and that will be our utility subsidy eligibility that we would put on Form 52723 for the overall subsidy calculation. So let's talk about the reporting period versus the 3-year rolling base period and this utility incentives. And let's go back to the first slide, or let's go back over here. So on slide 13, you'll see line 1. This is the most recent reporting period, and it compares it to the past 3-year rolling reporting periods, and it gives you an average, right? So we're taking this reporting period and it's going to compare it to the average of the past 3-year rolling base periods. Based on the utility type, so there will be one of these calculations done for each type of utility the authority has. If the reporting period is lower than the 3-year rolling base consumption, the PHA will be paid on the reporting period consumption plus 75% of the difference between the reporting period consumption and the 3-year rolling base consumption. So in other words, what's happening here, the housing authority is getting rewarded for reducing their consumption. No matter what, the housing authority, HUD's going to fund the housing authority on the lower of the reporting period versus the prior 3-year rolling base average consumption. The reporting period is the most recent consumption versus the prior 3-year rolling base average. So when you're reducing consumption, HUD is rewarding you to say, hey, good job. Even though we're paying you on the reporting period, which is much lower than the 3-year rolling base, we're going to fund you on the reporting period plus 75% of the difference for reducing consumption. Because when a housing authority reduces consumption, that's less subsidy you're going to receive. But if the reporting period of consumption is more than the 3-year rolling base consumption, the PHA would be paid on the 3-year rolling base consumption plus only 25% of the difference. Since the consumption was not reduced, the PHA only receives 25% of the difference. So the housing authority maybe didn't take any initiative to say, hey, let's try to reduce consumption, and cost and consumption went up. So therefore, you're getting funded on the lower 3-year rolling base consumption plus 25% of the difference. So there is an incentive to reduce consumption. There's a disincentive if your consumption is not reduced versus the 3-year rolling base. When we look at the beginning of HUD Form 52722, you'll see there's a column for each type of utility the authority has. The utilities that you see at top is only some. We could have steam, water and sewer could be separated and not combined. So that's the type of utility. And then just beneath that, we have the type of incentive, the type of incentive. And there are typically 4 types of incentives: non-frozen, flat rate, frozen, EPC, frozen, other. A non-frozen means that the rolling base period is from the prior 3-year rolling or reporting periods, actual costs. The flat rate means, hey, we don't have to track consumption because the utility just bills us a flat rate, and HUD will fund us for that flat rate. Frozen EPC, Energy Performance Contract, means that the consumption on the 3-year rolling base is frozen before energy conservation improvements were made. So the 3-year rolling base is very high, and the reporting period is going to be lower because the housing authority took an initiative to reduce consumption and they invested in their infrastructure. And we'll show you how that works, because this is a slight change to the methodology of paying on the lower of the 2, reporting period versus 3-year rolling base. And we have some slides to go over that. Frozen other is really for a small rural PHAs that can freeze their rolling base. And if you're one of those small rural PHAs, there are PIH notices out there that detail this. And each year, when it comes to subsidy, HUD will publish a funding notice, a PIH notice that talks about what years they're using for certain types of parts of the calculation. In addition, they will add some guidance as well on the subsidy calculation. In this example, we have water and sewer and electric. And this is a form that was submitted via the portal in HUD. So we submit subsidy online in the operating subsidy portal. And both of these are non-frozen. You'll see the PHA amount on top and the HUD on the bottom. And that's just what the PHA submitted versus what was approved. So for here, in this reporting period, we had 2.6 million gallons. The utility consumption is right underneath on line 1A. 2.6 million gallons of water. And then for electric, we had 87,000 kilowatt hours being used. The 3-year rolling base consumption level is equal to the average yearly consumption for the 36-month period ending on June 30th. That is 18 months prior to the first day of the applicable funding period. So yeah, this gets a little confusing for sure, and we have an example to go over for you. Here's what this means. So remember, the reporting period for 2024 is line 1, 7/1/22 to June 30, 2023. We're going to compare that to the average of the prior 3 years rolling base periods. So we got July 21 through June of 2022, July of 20 through June of 21, July 19 through June of 20. And this is a 3-year rolling base. This is what we'll compare the reporting period to. When we compare the reporting period on line 1, it's going to be compared to the average of those 3-year rolling bases. So you see here, we'll look at what HUD approved. We got 2.6, 87, 133, and 995. They compare it to the average 3-year rolling base, and they're always going to fund you on the lower consumption. It's just the way it is. Now, unless there's a frozen rolling base in which HUD will use the frozen 3-year rolling base, which would mean these numbers here will all be the same because HUD freezes it to fund you more money to pay for those improvements that we'll explain in some upcoming slides. So let's go through this example here. Here for water and sewer, we got 2.6 million gallons. The 3-year rolling base is 1.5. So HUD's going to fund us on the 1.5. Here, the reporting period consumption is 87. The 3-year rolling base for electric is 96. HUD's going to fund us 87. For gas, we're at 133,000 versus 146 on the 3-year average. So HUD's going to fund us at the 135. And then lastly, for fuel oil, we have 995 gallons versus 1,300 gallons. HUD's only provide funding for 995 gallons because they're going to take the lower of the reporting period by utility type versus the 3-year rolling base and fund us on the lower of the two. The next step is to apply that utility consumption incentive. When we come back to, let's go back to this slide over here. We got 2.6 versus 1.5. HUD's going to fund us 1.5 plus 25% of the difference because our reporting period consumption is much more than the 3-year rolling base. But when we take a look at the 87,398 versus the 96, since the reporting period is less than the 3-year rolling base, they're going to fund us on the lower, the 87, but 75% of the difference because the housing authority did a good job of reducing costs. The next piece is to take the actual cost of the total utilities and obtain a rate. The utility rate is determined by taking the most recent 12-month period, that's a reporting period in line 1, right? And along with that, the cost. So we're taking the average utility cost that we have, and we're looking at the total consumption related to that cost in line 1 to obtain our rate. So we're going to take the total consumption divided by the total cost to get a cost per unit per unit of consumption, right? So we could say we're paying 0.03 cents for water, 0.3661 for electric, $2.3, $2.30 for gas, and $4.50 for fuel oil. That's all that we're doing there. We're taking the most recent, we're taking that reporting period, consumption and cost. We're taking the cost, dividing the utility cost by consumption. The next step on the 5272 is excess utilities. Excess utilities are being charged for residents who use more consumption than they're typically allowed to. So for an example, sometimes the housing authority will allow a resident to put in a window unit in for AC or have an extra refrigerator. Well, the housing authority is going to charge them for that excess consumption, and we're going to obtain that excess consumption and costs and record it because we're charging the tenant for that. And we also have to report it on line 19 of the 52722 because we have to reduce our subsidy for that. If we don't, we're double dipping. Since they're funding us on authority paid utilities, and since this participant is living in a public housing unit that the housing authority is paying for those utilities and getting funded by HUD, any additional charges we have for the residents for any type of excess utilities they're using, we have to reduce it out of the subsidy so we don't, get the double funding. We don't charge a resident and we don't receive additional subsidy. So we got to be very careful to include that on the form. The next piece we have is something called a utility inflation factor that we discussed a few slides ago. And the utility inflation factor is the difference from the reporting period to the funding period. Because we know that when we collected the data 6 months before the fiscal year began, almost 18 months ago, it's when we started to collect the data, a lot of things have changed. So HUD does a utility calculation. HUD goes to the US Department of Labor, the Bureau of Labor Statistics, and they get this inflation factor. And for 2024, I believe it was 13%. So it takes the total funding that we're allotted and it says, hey, it's a 13% inflation factor, and that's what we're going to increase your subsidy by. With that being said, it's the same inflation factor for everybody, regardless of the area that you live in. And on HUD's website for operating subsidy, they give you the details on how it was calculated and all the background on this utility inflation factor. The eligible unit months is going to come from HUD Form 52723. Based on the subsidy calculation, when you take a look at line 24, HUD's going to fund us $489,520. But based on the eligible unit months for funding, you take the 489, you divide it by the eligible unit months that comes from a HUD Form 52723. HUD's going to fund us $203.80 per unit per month for the calendar year. And we would plug this number ultimately right into HUD Form 52723. Since HUD is basing our subsidy from the reporting period and they compare it to the 3-year rolling base, we have to adjust for anomalies, and we have to adjust for any increases or decreases in units. So when a PHA removes a unit from inventory, we have to go back into the 3-year rolling base and make it comparable. So if 100 units got removed this year, we got to go back to the 3-year rolling base and figure out how much consumption we need to move for those 100 units. Guidance on how to adjust the rolling base can be found on this link on slide 30. In addition, if you go to hud.gov/react, actually I think it's /react, you'll be able to go to operating subsidy and then click on the calendar year, and you'll see a lot of guidance for this information. It's really, really useful. The next piece is utility incentives. So we talked about the frozen rolling base, right? That's the big one. The frozen rolling base is one of the biggest incentives that's out there for a lot of housing authorities who do improvements. So what's a frozen rolling base and what does it mean? If a PHA undertakes energy conservation measures, meaning they're doing improvements to the infrastructure to reduce consumption, and they're getting a loan, so they're financed by an entity other than HUD, the PHA may qualify for these incentives. Approvals based on the determination that the payments under contract can be funded from the savings of the energy of costs. HUD has to approve this, of course. So all this is HUD approved. What's happening is the housing authority spends X amount of dollars to do these energy improvements. They take out a loan. And then the way the formula works is the savings that they have from these improvements is going to pay off the loan. Again, all this must be approved by HUD. So how do they take this money and use the savings to pay off the loan? Where does the money come from? Here's how it works. In theory, the frozen rolling base consumption is much higher than the reporting period. This is due to the 3-year rolling base being calculated before the energy improvements, thus receiving additional subsidy to pay for utilities and the loan for the energy improvements. So it looks like this. When we take a look at water and sewer on the very right column here, okay, that's frozen. When we take a look at gas, that's frozen. The non-frozen is electricity. So on the non-frozen, what's happening here, right? You'll see that electricity was 607,000 units of consumption versus the 3-year rolling base of 608. And of course, you get paid on the lower of the two, the 607. But when it's frozen, even though the reporting period is less, they're going to fund you at the 3-year rolling base level of either 50,000 units or 2.5 million units. And that extra money that you get in subsidy will go towards paying off the loan to HUD. There's another rate reduction incentive as well. So the rate reduction incentive is a HUD-approved incentive to pursue special significant efforts beyond what's required by statute or regulation. So the housing authority is doing something extra to reduce their energy costs to the PHA. That could mean going directly to the wellhead to purchase natural gas, taking some legal action to reduce rates for, rate paid for utilities and other types of actions as well. There is a notice that comes out each and every year when it comes to the rate reduction incentive. And it's a good way to reduce your costs. So what happens is you would get a HUD approved letter once it's approved for each amp and the additional money you will be getting. And you'll be able to enter that money here on line 23 of 52722, and you would get that additional subsidy. So let's talk some miscellaneous items. And when we talk about miscellaneous items, we're going to first talk about required documentation, retention, and so forth, and then talk about data distortions, which has been in the PIH notice for operating subsidy for several years now. They've really been focusing in on this. Housing authorities are required to maintain utility records satisfactory to HUD. This is per the regulation. All records must be maintained by utility and by AMP. When HUD says project, it really means AMP for a 12 months period ending June 30th for the fiscal reporting period and the year in the rolling base. So information they could ask for could include copies of all utility bills. If you're a large agency, you may have a lot of them. If you're a smaller agency, you won't have as much. They want to see a utility register. Maybe you're using Excel or some other software program. By AMP, meter number, unit of measure, consumption, and cost. So you may have 3 developments in AMP number 1. You may have a meter associated with each unit or developments. The unit of measure is gallons, metric gallons. The consumption is the consumption used for the period, and the cost is the cost of the period. And usually we get those monthly utility bills, and that's what they're going to want to see in detail, the monthly utility bills. And remember, I always say, have a little comment column there to record any anomalies on why something may look out of line, because HUD will ask as to why you have data distortions. So the housing authority must report its rolling base so it does not materially distort the rolling base period. And there could be many events that could trigger a distortion. Some of the most common ones are a transition from PHA paid to resident paid utilities, broken meters, water leaks, changing in units of measurement, interrupted service, increase, decrease in units, and so forth. Regardless of the cause of the data distortion, the PHA must ensure that its rolling base periods to consumption levels are directly comparable to the actual reporting period. So they want to make sure if there's material consumption differences, they want to know why. Like there has to be a reason why. If there's unexplained declines, this is where HUD gets very nervous about. Because if you remember, if the reporting period declines significantly compared to the 3-year rolling base, the authority gets 75% of the difference. So they don't want to overpay any PHA, because if there is an overpayment, HUD will get that repaid back to the PHA. And they have to make sure the data is accurate. If HUD sees that the data is not accurate and that a PHA can't explain it, don't be surprised, okay, if HUD makes the adjustment themselves for any unadjusted data distortions, and you could lose subsidy. So that little comment column that I've been throwing in there every now and then, it is very important, when you track your utility cost and consumption, to make sure that when HUD questions you, you can explain why you have a data distortion. You could say, hey, it was hotter this summer than last summer. Occupancy increased. we have that. That's important information to have. The data you have regarding your cost and consumption is very important. Okay, we're going to leave it here for any questions that any folks may have had.
Okay, great. Well, I don't see any questions at this time, but as a reminder, please use the Q&A panel in order to put your questions. And as a reminder, you can use the feedback link on HUD Exchange for any outstanding questions or to provide feedback about our training today. We would like to acknowledge HUD's support. This webinar was developed through HUD's Community Compass program, which is a program that provides technical assistance to PHAs and other recipients of HUD funding. We haven't received any questions, so we'll go ahead and conclude the webinar, but we'll stay on the line in case any other questions come through. Thank you for joining us, and we hope to see you in a future UEL webinar.